Welcome to the Bean Pod, a podcast about decentralized finance and the Beanstalk protocol. I'm your host, Rex. Before we get started, we always want to remind everyone that on this podcast, we are very optimistic about decentralized finance in general and Beanstalk in particular. With that being said, 3 things. First, always do your own research before you invest in anything, especially what we talk about here on the show. Second, while you're doing that research, try to find as many well-developed, opposing viewpoints as possible to get the best overall picture. And third, never ever invest money that you can't afford to lose or at least be without for a while. And with that, on with the show. So Publius, you've talked us through a little bit about pods and that first in, first out process and the percentage return. What I'd like to pivot to is what we call the pod marketplace. So individuals that buy pods, if they're buying them now, they may be a ways out in line. They may be 600, 650, even 700 millionth in line. So a lot of waiting to do. And if individuals aren't interested in waiting that long to get the return on the investment that the pods offer in their, let's say, like purest sense, we've created this pod marketplace where individuals can take pods that they own and they can sell them. And in turn, individuals that are looking to buy pods can buy them at a discount and either hold them till they mature or resell them. Would you talk us through a little bit about the underlying principle there and how individuals have used that to make really smart buying and selling decisions?
Sure. So pods are unique, right? You wouldn't ever trust a bank if they said to you, "Yeah, we'll put your place in line down. We promise we won't let anyone cut you in line, and we'll let you know whenever we owe you the money that we owe you. There's no fixed maturity on the loan, but we'll let you know when we owe you." Like that doesn't really fly in a trust-based financial system. And so the idea of having debt ordered, having debt actually first in, first out, and not have any sort of fixed maturity is unique. And accordingly, there isn't within, certainly within DeFi, a good mold with which to build a DEX for pods off of because of the fact that they're ordered, right? You have a place in line or a group of pods that are spread out across a certain stretch of the line. And as Beanstalk pays off debt, it may actually move within the line, right? Because you move up in the line. And so the question is, how can you create an efficient exchange for pods? And the farmers market, which is the marketplace for pods, was a community-led initiative. Actually, now Beanstalk Farms brought on the main dev who worked on the pod marketplace, but the pod marketplace was a community-led initiative to basically create a Beanstalk native protocol to exchange pods. And in short, there's a lot of future upgrades that can be made to make the pod marketplace even better and more liquid. But already there have been like almost 6 million pods exchanged for over 600,000 beans. And there have been like well over 100 transactions in the market since it launched just about a little over a month ago, I believe. And so in short, anyone can now come and sell their pods in a trustless fashion or buy pods from anywhere they want in the line in a trustless fashion. And that liquidity that's offered by the pod marketplace also creates some pretty cool opportunities in the sense, as you were talking about, Rex, where you may have locked in this really high return, but now for whatever reason you need some liquidity, whereas before you were kind of stuck holding your pods. Now there's a decent amount of liquidity in the pod marketplace such that, you're not necessarily locked in. And when we think about creating an efficient market for Beanstalk across the board, and creating an efficient market for soil for Beanstalk's. You know, anytime Beanstalk is willing to borrow beans, the goal is to have as an efficient market to lend beans to Beanstalk as possible. Having a secondary market where there's liquidity for those loans, for those pods, is really awesome. And if we go back to what we were talking about before about like, well, what else might get built on top of Beanstalk? The pod marketplace, which is sort of built on top of the core mechanism, right? It doesn't directly have to do with how Beanstalk maintains its peg. There's all sorts of other stuff that in the not too distant future will hopefully get built on top of the pod marketplace to facilitate even more uh, cool innovation within DeFi. So one potential use case for the farmers market, for the pod marketplace to shed out, is Fiat DAO, which is a protocol that facilitates borrowing against zero coupon bonds in a decentralized fashion. They're interested in accepting pods as collateral in their protocol to borrow against. So the fact that now you have a liquid secondary market for pods actually facilitates lending markets to be built on top of pods as an asset as well. And so when we think about what are all the possibilities that can get built on top of Beanstalk, this is just one example of something that we didn't come up with. One of our community members said, "Hey, you guys got to talk to Fiat DAO and set up the whole relationship." Things like that are really, really encouraging.
Yeah, so you gave the shout out to Fiat DAO, which I was going to, which is awesome. I'm going to give another one. I'm going to give a shout out to Olympus DAO, the Omis. Watching some of the traffic on Twitter this week, it seems like we've got a handful of friends in Olympus DAO that have suddenly seen the opportunities in the pod marketplace. And the term that I'm going to use kind of has a kind of negative connotation in traditional finance. The term is arbitrage, but they have identified this arbitrage opportunity where they can buy pods at a specific rate, hold on to them for a certain period of time, and then resell them, never having been part of either the origination or the final harvesting, just making margin in between the two. And I think that's going to be an opportunity that we're going to see more and more. And to talk about arbitrage for a second, I mentioned that it's usually seen as kind of a negative thing. In a system like Beanstalks, it's very useful because it creates efficiency around utilization of the assets. And so where in so many instances people talk about arbitrage in the sense of one party taking advantage of another, even though the loose definition still kind of makes sense for us in Beanstalk, that taking advantage creates a more efficient, frictionless system. It eventually creates um, a really efficient place where transactions can take place.
That's just a great example of how individual actors that are acting in their own self-interested capacity, looking to profit, are actually creating utility and creating a more efficient market and a more efficient system within Beanstalk. And that is a good indicator that the incentives that Beanstalk creates and the structure of Beanstalk are working, right? Because that's ultimately the goal of well-designed trustless protocols, is to incentivize exactly that. Independent actors who are just doing their own thing to ultimately, somehow in some fashion, ultimately coordinate to create real utility for users of a protocol.
All right. We've talked about the beans themselves. We've talked a little bit about the field and how individuals can get involved on the debt side. Let's talk about the silo. So, for those of you who are unfamiliar, the silo is really the way that I describe it is somewhere between a bank account and a governance tool. And so I think what we'll have you do, Publius, is if you would, the silo breaks down into a couple components, Stalk and Seeds. How would you start us out by talking about what Stalk does, knowing that there are a couple different things that it does and it's a little bit complicated? Would you just start us off talking through that concept?
Sure. So at its core, Stalk is the governance token of Beanstalk. And for reference, anyone can acquire Stalk for themselves by depositing their beans or various other whitelisted assets like relevant LP tokens uh, into the silo. And anyone who owns stock is entitled to participation in Beanstalk governance and also entitled to a portion of all future bean mints while they're holding stock. And for reference, anytime the bean supply increases, when the price is too high for a season and there's excess demand for beans, the the bean supply is able to increase to meet that demand arbitrarily. And half of all beans that are minted go to silo members, stockholders in the field. A silo member is someone that holds stock, and half go to paying off pods, paying off debt in the field. And so if you hold stock, you can passively earn interest in the form of new beans, and those beans are automatically also deposited in the silo and earn stock and therefore earn compounding interest. So the silo is, as you said, sort of a bank account in that people can earn passive interest from Beanstalk. And on top of that, because stock is the governance token of Beanstalk, anyone can also participate in the governance of the system. They don't have to necessarily because there's no requirement to vote, but that's how stock works in a nutshell.
A point I'd want to emphasize is that much like a bank account, and we can juxtapose this a little bit to pods. You're in the silo. If you're using beans to buy stock, or if you're using ETH to buy stock, you still have liquidity. I feel like that's an important distinction to make as individuals are looking to interact with the protocol and they're thinking, oh, I'd like to get involved. Should I buy some pods? Should I buy stock? What are seeds? To be able to offer stock as an option for passive interest while an individual still maintains that liquidity, I think is a really special. And it to look back at the comparison between collateralized stablecoins, this is another place where Bean kind of flourishes because that neutral carry cost, that the fact that an individual is not essentially losing value by holding onto a coin gives it that extra utility that will make those future transactions and those future places where Bean can be used, it makes those systems much more easy to create and sustain than the idea of having USDC or USDT, which every minute that you're holding that and it's not being lent to someone else, you're sacrificing value, you're trading that value, you're losing out. Whereas with Bean, you can have your value move in and out of that silo. And as I'm sure you'll mention, there's an incentive to keep it there through the seed system. But at the same time, if you want that liquidity, you can use it and you're not losing value just by holding it.
Yeah, I mean, there's so many ways to go with this, but if anything, you highlighted it, Rex, which is the fact that you can hold your beans, still own your beans, and earn interest and participate in the growth of Beanstalk. That really is the core differentiator between Bean and any other stablecoin, right? So even let's take something really innovative like Terra, which Terra figured out a solution to the collateral problem because they use Luna as their collateral And Luna, the value of Luna can float freely. It's a protocol native asset. There's nothing capping the value of Luna. And therefore, speculation on the future demand for Terra or UST, which is their dollar pegged Terra, um, effectively results in growth in Luna, in the price of Luna, and therefore the growth of the available collateral, which increases the stability of Terra, the stable coins. But ultimately, if you're holding the Terra, there's no way for you to participate in the upside in the growth of that system. Now they've created Anchor, which is a way for basically Luna holders who are receiving all of the upside in the seigniorage, all of the growth of the ecosystem goes to them, for them to hand out effectively some of that upside to the UST holders to create like what effectively amounts to the facade of utility, right? You can hold our stable coin for us to give you a handout in the form of a little bit of interest, but in reality, whoever holds Luna gets the vast majority of upside in the system. In the case of Beanstalk, because stock can only, I mean, you can buy stock on the open market, but the only way that stock is minted is if someone deposits value into the silo, and anyone can do so. There's no monopoly on, or there's no concentration of ownership of the upside in the system. And anyone that holds beans can also participate in the growth of the ecosystem. And that is what ultimately fundamentally sets beans apart when it comes to product market fit and when it comes to utility.
Yeah, so it seems like that system, that stock system, has a couple unique components, and something that I saw on one of the recent YouTube videos, some content creator put out just over the last few days that actually talked about Beanstalk, was they talked about the idea of eventually stock being liquid. And I don't want to get too far ahead because I think we're going to talk about this here in a couple minutes. But having a governance token that both has the interest component and that governance functionality, as the protocol and the organization evolves, being able to transact with that, I think, will add a whole new layer of functionality into how Beanstalk is governed, and then in turn how we create value through really particular that particular passive interest option.
Stock is currently not liquid. There's a question as to, well, what should stock be worth, right? Stock is some sort of future on or derivative on the future bean supply. And in practice, when you have an asset like that that is primarily a function of future interest, it, the question becomes, well, how do you value that future supply? Now, the issue is that when you when you try to price stock, it's very tricky to figure out, well, what is stock worth, or what should it be worth. But one thing that's really cool, and when we talk about how, like, anytime there's a future a growth in the expectation of the Terra supply, that results in a massive growth in the value of Luna, right? The value of Luna goes up in the same way you might expect future expectations of bean supply to grow to result in an increase in the price of stock. And so, in that way, stock may trade as a proxy for the future expected growth of beanstalk over a certain period of time. And if there's more expected growth in the short term, maybe stock trades higher than if there's less expected growth in the short term. But one thing that's important to note is, because you can always deposit one bean in the silo in exchange for one stock, by definition, the price of a stock should never exceed one bean. Because if it did, you could deposit your bean in the silo, sell the stock for more than one bean, and then deposit those more than one beans in the silo and do that until the price of a stock had returned to at least, or at most, the price of a bean. And so, while it's hard to know how stock will trade, from an economics perspective, one might expect the price of a stock to be capped at the price of a bean.
Oh, okay. All right. So knowing that, can you see a scenario where there would be an opportunity for a marketplace rather than that was specifically focused on pods, instead being focused on stock and ways that individuals could really take advantage of kind of the compounding opportunities with liquid stock?
The only thing to note is that when you have stock, having a liquid market for stock is beneficial to Beanstalk. So one might reasonably expect for Beanstalk LP tokens, wherever stock trades, to be whitelisted on the silo whitelist in order to be uh, deposited in the silo, such that you may be able to receive more stock for providing your stock and beans as liquidity to the stock pool. And so what you might be able to do is roll over your stock and take on some sort of leverage on your stock.
So, right along with this idea of stock are these other things that we call seeds. And seeds are essentially a way that a stock holder can get more stock. And there's a compounding mechanism, and there are a lot of pieces that go along with this. And I know that especially for individuals that are new to the protocol, this is probably one of the places where there's the most confusion. So, Publius, do you want to just talk for a couple minutes about how seeds work and what they do, and maybe even the future of them, whether or not we'll use them in the future?
Sure. So when you deposit assets in the silo, you don't just receive stock, you also receive seeds. And seeds, as you said, entitle you to more stock in the future over time. In fact, stock grows 1/10,000th of a stock grows every season, every hour from each seed. Now, why is that? You might be asking. So, the silo is the Beanstalk DAO, and there's all these assets deposited in the silo. And the main reason for people to deposit assets in the silo is to receive interest, right? Other than participating in governance, it's to receive interest. And the real interest, the seniorage of beans, only gets minted when the price of a bean is above $1. And so you have this naturally reflexive aspect to Beanstalk where when the price is above one, you want to be in the silo. But when the price is below one, there's no real natural incentive to be in the silo. And that created in similar systems like ESD, real runs on the bank, where when the price of an ESD was below $1, there was no incentive to be in the DAO. And so in the case of Beanstalk, Beanstalk needs some way. It can't mint beans, right? Because if it minted beans when the price is below one, that would create more supply and cause the price to continue to go down. Beanstalk needs some other way to incentivize people to remain deposited in the silo. And so what Beanstalk does is it rewards more stock over time for remaining deposited in the silo. Now, one thing to note is Beanstalk tries really hard not to disproportionately reward earlier investors. Going back to that Ponzi question, even though Beanstalk is fundamentally different, one thing that Beanstalk really does try to stick by is a low concentration of ownership. And in order to facilitate that, you can't excessively reward earlier investors into the silo. But at the same time, you need to offer them some sort of stock reward to encourage them to stay deposited in the silo, even when the price is below $1. And so, from a rules perspective, when you withdraw assets from the silo, you have to forfeit all of your stock, all of your seeds, and all of the stock that grew from your seeds for that deposit. And so, in short, there's an opportunity cost introduced in the sense that if you were going to if your plan was to withdraw and then deposit your assets back in the silo again in the future when the price was back above one, you have to evaluate the opportunity cost associated with those actions against all of the stock that you have to forfeit for having already spent some time in the silo. And so by rewarding stock over time, Beanstalk creates an opportunity cost for leaving when the price is below one. Now, the other thing to note is that because stock is rewarded linearly, this incentive effect really has the most effect on the individual level. Meaning, if I deposit today, roughly, if I deposited beans today, roughly every 200 days or so, my stock would increase by the amount of stock I originally started with. So after 200 days, I would have 2x stock. After 400 days, I would have 3x stock approximately. And if we think about how this plays out with multiple participants, even if you deposited 200 days ago, Rex, so you now have double the stock that you started with, in 200 more days, you'll only have 3x the amount of stock that you started with, whereas I'll have 2x. And then in another 200 days, you'll have 4x and I'll have 3x. So the amount of upside that you have over me for depositing sooner decreases over time. Whereas at the individual level, the incentive, the stickiness, the opportunity cost for leaving the silo, that increases over time.